I didn't know there was so many videos about Dave Ramsey not liking cash value policies. I want to go through this video. This is my first time seeing it, so let's go through this video. Let's see what they got to say.
Thanks for joining us, America. We're glad you're here. Russ is with us in Salem, Massachusetts. Hey, Russ, welcome to the Dave Ramsey Show.
Hello, Dave. How are you?
Better than I deserve. How are you?
I am good. Dave, I posted some things on your website in regard to insurance philosophies you put online. And having been an insurance broker for about 35 years, there are a few misstatements that are on there that I'd like to use the air as a chance to maybe either clarify with you or maybe get some clarity from you on. May I do that?
Sure.
Okay. Number one, you have said on your website that term insurance is the best and the only kind of product people should buy in all instances when they need life insurance. And what I can tell you is that we do not recommend whole life insurance across the boards. We recommend life insurance situationally. There's no two needs, no two situations that are pervasively similar. Okay.
So it sounds like the guy that's calling in, he sounds like a broker. He sounds like, some of more of me. He came up the ropes like how I came up. You hear a lot of times where people are like, oh, this is the only way to do certain things. Why? Because typically that's the only thing that they could sell. That's the type of license or that's the type of company that they're with. They're not with they're with a captive company that only allows them to sell that specific product that company offers. So it sounds like he can do multiple things. That's why he has a different idea of several things. So let's keep.
Okay. Can you hear me all right?
Yeah, I'm hearing you. Yeah.
Okay. Number two, the cash value that you've talked about is
Wait a minute, did you want me to address that one first?
It's up to you.
Okay.
If you'd like to, I'll be happy to do it one at a time.
Well, you're an insurance agent, obviously, and I disagree when you say there are no two instances that are the same. There are basic principles of mathematics and basic principles of personal finance that are always the same. For instance, I would tell you there is never a time that you would use a credit card.
Mm-hmm.
You can't say that you can't convince me that there's certain times you should use a credit card. They suck. They're a bad product. They don't work. And I think the same thing's true of whole life.
Mm-hmm. All right. Well, let's take it a little bit further. Number two, there seems to be some question about the cash value of a life insurance policy.
Damn, Ray's never use a credit card? I mean, I don't know. I can't say never. Never is crazy. Anybody that says never, not even saying credit card, but never get a whole life or index universal, that's a little different, Dave. Never? Okay.
Policy as being a bad investment, and I won't get into the issue of performance, but I think the big thing that you need to realize is.
And then another thing I want y'all to know, look at this advertising. Sign up for term insurance. Like, come on now. Like, I think what people miss out on is the fact that, listen, if I'm pushing a certain type of product, my marketing tactic is usually bump them other products. You need to be on this type of product. So a lot of times, some people don't even know nothing about the other products. All they know is that they get more influence. They get more influence, or they get more traffic by saying bump the other products, and it allows them to go ahead and tap into an audience that already has it. So it's a lot of people that, oh man, I got a whole life policy. Oh my God, let me get a term. So it's like, you just never know. Let's just keep going. Understand? Marketing is everything.
Is this the cash value is not there because insurance companies are creating a standard of return or investment that is deemed to be poor or is deemed to be immovable. The cash value.
Then why would you do it?
Policy is there. It's a function of law. It involves.
So why would you put extra money into a policy to create cash value if the cash value has no standard of excellence at all on the rate of return?
Well, you didn't let me finish. Those policies historically get better as they get older. Okay, the cash value of a life insurance policy is a function of state law. It's a function of statutory reserves.
Sure.
And also from an actuarial standpoint, it's used to keep premiums level indefinitely. Why do you think term insurance is so cheap?
Disclaimer for the guy that's talking, right? Or for both of them, really. Just because you have a policy that has cash value does not mean your policy was designed to build cash value. I know it sounds crazy, but that's the truth. Just because a policy has a cash value account doesn't mean that the full account was designed, like the full purpose of the policy was for it to be a cash value policy. So you have to understand that if originally, once you got that policy, if you didn't say, hey, listen, I want a cash value policy, that agent or whoever, the company is not going to adjust the cost of insurance to make sure that the cash values are built up in a speedy amount of time. Like, it's just not going to happen. So when you got people that are fighting, I'm even on his side, I ain't on nobody's side, but even on the other guy's side, when you have people that are fighting so hard about these cash value policies, you have to understand that the average person don't understand what the heck is going on. So when they say whole life or they say index universal, they're really talking so broad to a point to where you have people that don't even start building cash value until year 7 or year 10 versus, you come with my team. Go ahead and click the link in below. Go ahead and subscribe as well. But go ahead and meet with my team because they're going to allow you, especially if it says whole life. If you are getting a whole life, you build cash value day one, your first payment versus having to wait a whole bunch of years. So you have to make sure that it's designed for it to be a cash value policy versus, just a regular insurance policy that just happens to have a cash value component.
Because term insurance does not have or maintain a legal reserve affixed to it.
Well, sure it does. They have to have cash reserves to support.
Reserves,
otherwise, the state won't license the term insurance company. Now, it's a 20-year level term. 20-year level term insurance is about 1/5 or about 1/20th the cost, about 5% the cost of the same amount of whole life is.
You're right, but from an actuarial point of view, whole life is considered to be a product priced indefinitely that does not have.
Yeah, but it never stays in place indefinitely.
That depends upon the person, and that depends upon the situation.
All the research shows that they cash them out like crazy.
Not everybody.
Yeah,
I can tell.
Yeah. The vast majority do. But let's just pretend you kept it for your whole life. Why the flip did you need it for your whole life?
How about some things called estate taxes? There are people who do, when they die, see their family.
Why did you need it for your whole life? Dave, I ain't gonna cap. I don't understand why you said that. Somebody give me some context on why he asked, why would you need life insurance for your whole life? Maybe because of, even if you get older, maybe because from my understanding, term usually, cuts off for people when they get to like their 70s or 80s because their term has expired, and majority of those people, they're uninsurable or they can't afford a term policy. So it's like, yeah, you should have some type of insurance. Even if you're passing down assets within your mutual fund or anything like that, you should have some type of life insurance because it just makes sense. You're taking pennies to buy dollars. You should have some type of whole life policy that outlasts your term. And I'm not one of those people that's going to tell you, hey, just only get a whole life, only get an index universal, or only get a term. I think all of that is just stupid. Like y'all don't own none of these companies. I think they all have their pros. And they all have their pros. There are no cons. It's like literally they're going to pay out. But for him to say, they just historically numbers show it doesn't pay out. Come on now. Come on, Dave.
Incur a substantial financial loss.
And so in order to cover estate taxes, I need to get ripped off for 60 years in a horrible financial product. That's your theory.
Well, let me just say this. If you talk about the difference of investment, why don't you talk about the difference for example, in attorney's fees? There are attorneys who charge $300 an hour versus $700 an hour. You don't tell somebody to invest the difference in legal fees to see if they come out ahead, do you?
Of course I would, if the actual if the actual legal advice was exactly the same.
Well,
if you die, you get paid with term insurance. Your beneficiary gets paid. Pretty simple formula. If you die with whole life insurance, your beneficiary gets paid only the face amount after you've paid 20.
Damn, Dave, that's not true. That's not true. Hey, listen, that's not true. Listen, that's not true. You do not only get the original death benefit on a whole life policy, okay? That is just not true. Now, here's the thing, right? Again, you have a lot of cases to where, especially if this is an index universal like policy, where the cost of insurance doesn't grow over time. Sometimes it makes sense for the cost of insurance or the death benefit to not grow for a certain period of time, and then it starts to grow. Or sometimes you have different situations. Now, with a traditional whole life policy, I haven't seen it to where the death benefit doesn't grow if it's designed as a cash value. Now, typically, let's say you start your policy off with 50,000, right? And you dump in an extra 100,000. Typically, you just add in 100,000. You start off at 50,000. Now your death benefit is going to grow along with the cash value. So now your death benefit might be 170,000. So for them to say you don't get it, the only time that you do not get it is if, of course, you borrow that whole 100,000, right? And this is used as collateral. You borrowed the full 100,000. It's still growing interest as if the full 100,000 is still there. And now you're in a situation to where, of course, it will subtract from your death benefit. Your death benefit is now 170,000, not 50,000. Because if that was the case, guess what? You would be indebted to the insurance company. So, come on, man, that's just not true.
Times more for the policy.
I can refute that very easily.
Oh, you can't.
If a policy is arranged properly, a person can receive not just the face amount of the policy, but in addition, they can receive the value of the cash account.
No, they can't. Not unless it's not unless it's an AB universal, in which case you paid more for it to start with.
No, you do not. That is not true.
Are you talking about paid up additions?
Pardon me?
Are you talking about paid up additions?
No, I'm not talking about paid up additions. Did you ever have something called the fifth dividend option?
Sure.
Okay.
Absolutely.
What is it?
Well, absolutely. The bottom line is, at the end of the day, the people don't get the cash value. You pay 20 times more, and the cash value is not added on. Now, I mean, you can look at every major whole life company that's out there, and you tell me they get their cash values. They don't.
I'm not going to lie. Let me listen to that again. I know he didn't just say it. Let me listen to it one more time. Hold on.
Value is not added on. Now, I mean, you can look at every major whole life company that's out there, and you tell me they get their cash values. They don't get them. Russ, it's a piece of crap.
Are you talking about the beneficiary?
Listen, here's the.
Let me call an insurance company right now. Let me call an insurance company, because for him to say that publicly, it's kind of crazy. It's kind of crazy.
Welcome to Lafayette Live.
I'm gonna call Lafayette.
To ensure quality and service, this call may be recorded.
Let me call the salesperson.
1099s and other tax-related forms.
Let's see what they say.
Will be postmarked by January 31st and should arrive by February 15th. Visit Lafayette. Did you know you can obtain service forms and detailed information online at agent.llic.com?
Let me call an insurance company. Let's verify this.
9 options. For the sales desk, press 1. Licensing and Welcome to Lafayette Life. Please remain
Let's see what he says.
for the
I'm
next
calling now.
representative. This call
Let's
may
see
be
if this is
recorded
true,
for training
what
and
he's talking
quality
about.
purposes. Thank you for holding. All of our representatives are currently assisting other callers.
Now, if it's gonna
Please
take too
remain
long,
on the
man,
line.
Thanks for calling Lafayette Life. This is Gene, internal wholesale sales desk. Who am I speaking with?
Hey, how you doing? This is Keon.
Yes, sir. And how can I help you today?
Good. I'm watching Dave Ramsey. I just got a quick question. He said that when you get a whole life policy and you put cash value in it, you only get the death benefit, not the cash value that you put in it too. Is that true?
That is correct. The cash value that's in a policy can be used to borrow against or to take a partial surrender. What's your agent number there? Sorry about that. 417. Appreciate that. Yes.
Is there a
particular type of policy you're thinking?
Yeah,
talking about,
let's look at a traditional. Let's look at the Patriot, right? The death benefit grows with the cash value. Let's say the original death benefit starts off at 50,000. You put in an extra 50,000. Now your death benefit is 100,000. You didn't borrow from the 50,000 cash value. if the person passes away, they're going to get 100,000, not just 50,000, right?
Right. So it depends on how the policy is structured. But absolutely, I mean, most of the Patriots, those policies are most often written with an LPUA rider on it in order to maximize that cash value. And so, yeah, I'll give you an example here. Give me a moment.
So only if it has the PUA rider.
Well, no, not only if it has a PUA rider, but that maximizes the cash value. It helps the cash value become bigger.
Mm-hmm.
Do you have a current pending case right
No,
now
no.
in our system?
I just had
okay.
I just had a question. I just had a question. I just wanted to make sure, of course, for several purposes. So yeah, I just wanted to make sure because from my understanding, I thought I was a little confused. If a person puts in, because I've seen the death benefit pay out the cash value, so I just wanted to make sure. I just started writing with you all, so I just wanted to make sure. Really, it's nothing serious. I just wanted to make sure that hey, if the death benefit says 150,000 and 50,000 is the cash value, the client is going to get the full 150, not just the original 100,000.
Right. So I'm looking at a Patriot right now.
Mm-hmm.
It's got a 15-year term rider on it,
Mm-hmm.
and let's say in 10 years the policy owner passes away. Well, in year one of the policy, the way this one's written, the death benefit, including dividends, would be $330,810.
Mm-hmm.
In year 10, if he were to pass away, it would be $394,077. So it's grown by 64 grand.
Mm-hmm.
But the net cash value, had he not passed away, that he could borrow against or utilize, is $52,195.
Mm-hmm.
So that cash value does get added to, I guess, whatever the death benefit would be. But the actual death benefit is a cumulative total of whatever the face amount is plus any additional growth in the policy as a result of cash value.
Mm-hmm.
And again, that can be maximized through the use of one of those LPUA riders.
Mm-hmm.
So in this case, persons by year 10, 52-year-old male, standard non-tobacco user, by year 10 to put in $60,000 in the first 10 years, $6,000 a year premium,
Mm-hmm.
and the cash value would be $52,195. So of that $60,000, they still have access to $52,000 of it,
Mm-hmm.
but it buys $394,000 of death benefit.
Mm-hmm.
Whereas when the policy started at year one, it was only $330,000.
Mm-hmm.
So the death benefit does grow as the cash value grows.
Okay. Thank you so much. You've really answered all of my questions.
Good. I'm glad. We're here to support you, Keon. If you need any assistance in case design, or if you've got a certain client that's looking to meet certain objectives or needs, we can help create a policy for you, whether it's a Patriot or a Sentinel or
Mm-hmm.
Contender, whatever it happens to be, that's going to be best for what they want and their needs in the end, so that so you can get more successful with placing more business with us here at Lafayette Life. We want to make it easy for you, so that's why we're here at the sales desk.
Exactly. And last question: what's the usual minimum time frame? Let's say we design a Patriot, right? And they have a cash value. Let's just say they have a cash value of $10,000 starting off. What's the usual wait time frame for them to be able to borrow from that?
30 days from the day the policy is placed is when they can take out a loan.
Okay. Well, thank you so much.
Cash value happens to be. Absolutely.
You've been a really
cash
great help.
value will increase as time goes on. So if they're making monthly payments as opposed to annual, then the cash value is going to grow a little bit each month. If they're only making premium payments once a year, then typically the cash value wouldn't grow so much until that additional premium is collected.
Okay.
Once a year. Yeah.
Okay. Absolutely. Thank you so much.
Cool. Look forward to working with you more in 2025. Thank you for your trust here in Lafayette Life.
Absolutely. Thank you so much. You as well. Hey, have a blessed one.
You bet. All right, bye-bye.
All right, so I called the insurance company. At first he said no, he was kind of throwing me off, but he ended up saying yes because the way I worded it, he was like, no, you don't. But he get what I'm saying. I had to specify cash value. That's why when you get with these people, you got to specify the type of product and the cash value so they can understand. So let's keep listening.
Situation, dude. I can talk to you for the rest of my life, and I'm not going to talk you into not selling whole life.
I'm not even talking about whole life of term. I sell a lot of term, bundles of it.
But you still sell the other crap too, and you're offended because I said it's crap.
Now, let me ask you another question. Yeah, by the way, for your information, just so I'm not arguing with you, but the cash value, the amount of the value on top of the face of the policy can be paid to the beneficiary if the policy is written appropriately.
And none of them are written that way.
Well, I've written them that way for 35 years.
And for him to say 9 is crazy. No, that's not true. Come on, bro. That's not true, bro. That's not true, y'all. I just called the company.
No, it just doesn't happen, dude.
It
You and I
certainly
know
does.
that is not how the industry is set up.
Well, believe me, it is. The other thing is, you said that, you talk about whole life as being such a horrible product. And again, maybe in your mind it is, but can I ask you this question?
Mm-hmm.
Why is that particular product that you think is so deplorable, bought by many publicly held companies and privately held companies to fund buyouts of corporate stock? And
There's a lot of buy-sell agreements.
It's not even buy-sell agreements. There are a lot of companies, banks, institutions, whatever. How much money do banks have in life insurance? So there's a lot of institutions that put their money into insurance policies. So that's why, of course, 184 billion. That ain't no cup of change. Bank of America has billions of dollars. Wells Fargo, billions. JP Morgan, billions. PNC, billions. Truist, billions. I mean, when we talking about billions, we ain't talking about millions. We're talking about billions. So it has to be some reason why they're putting all of their money there. So, when people say scam, I mean, shit, the banks can scam too. Shit. I mean, hey. hey. Let's see.
Hi, this is Hutch with BankingTruths.com, and we help people substantially enhance their wealth building efforts by showing them how to build their own private banking mechanism. And in order to do so, we thought it'd be a good idea to take a look at the balance sheets of two of the biggest banks in America. And although the name's going to stay grayed out, what I can tell you is this is a very patriotic bank. And the definition of a balance sheet is assets and liabilities, what the bank owns and what it owes. And just cutting to the chase, if we scroll down to line 41, what you can see is they have life insurance, but they call it an asset. And the number associated with that asset is pretty substantial. It looks to be about 21 million, a little bit over. But actually, if we scroll back up, what we can see is the title of that column is dollar figures and thousands, meaning we need to add a comma and 3 zeros to that number. So it's actually over $21 billion in life insurance assets. Now
I ain't gonna cap 21 billion. That ain't no little money. That's your money. Shit, that's your money they're putting in there. So, hey, listen, hey.
Find a much more popular asset class, real estate, on lines 10 and 11 on this balance sheet. So if we look at bank premises and fixed assets, other real estate owned, it totals a little over $9 billion. So why, you ask, does life insurance make up more than double how much the bank owns in real estate? Well, let's scroll back down to life insurance and list the 5 major benefits that big banks get from parking these billions.
That is a good question. That is something that I did not know. So, better growth rate, tax deferred growth. Of course, they don't pay taxes. Better growth rate, because of course, real estate could be tricky. Liquidity, okay, because if they need it, they can, either borrow from it or they can surrender the value of whatever it's worth. Key person protection, if anybody, of course, passes away, they can put it on any of their executives at the banks or any employees, so makes sense. Or any persons that probably got a loan. So like if the bank, let's say that I lend you $1 million, and you know I don't know if you're gonna be able to pay that $1 million. I'm gonna take out a $2 million life insurance policy, because when you die, you're gonna give me my money back. What they say, back in blood. You're gonna get my money back in blood, right? High contribution limits, right? So they can put enough money in there for it to make sense, way more than they could in a 401k IRA or a Roth account. Okay, that makes sense. That makes sense. I don't know why it don't make sense to this guy.
Agreements that use whole life. You know why? Because people like you sell that crap to them.
No,
It's exactly why they do it.
Do you know how much?
A simple partnership buy-sell agreement can be funded with term life insurance for
know
1/20th of the cost.
Well, let me ask you this. Do you know how many publicly held Fortune 500 companies use whole life and the millions of dollars the boards of directors authorize for that
And it's
stuff
really
to fund
sad
executive
that they're all
benefits?
getting screwed at that level.
Well,
It really is, because it's garbage, Russ.
From very prestigious business schools. I think they know a little bit more than a layperson.
Well, they may or they may not, but the bottom line is that at the end of the day, dude, it is the payday lender of the middle class. It's a horrid product. When you pay 20 times more for the same amount of coverage to build up a cash value that you never receive.
One thing you're gonna say about Dave stand on business. He said, I don't like it. I don't care what y'all say. I don't like it, and I ain't never gonna like it. I don't even know what year that was, what year this was, but listen, he don't like it, even if you're proven wrong a million times. Listen, make sure you like, comment, subscribe, go ahead and book an appointment below. Let's get